Hi, everybody. This is Jeff Barton, and welcome to the Mortgage Minute. We're on a couple times a week. We try to get to Facebook and LinkedIn, Instagram, a couple other social media. We're also on YouTube. If you go there, Jeff Barton, the Mortgage Voice, you can see the Mortgage Minute when it does come out, and certainly the Mortgage Voice, which comes out once a week. We do that show, and that's about an hour long. These mortgage minutes are about 3 to 5 minutes. Anyway, enough of the commercial. Let's get right to it. Mortgage interest rates. Okay, if you've been sleeping, maybe you haven't realized, but mortgage interest rates have shot up dramatically over the past 6 weeks. We have gone probably a point to a point and a half higher than we were at that time, and people who were either considering refinance or some other form of, financing for the home, whether it's a purchase or a refinance, are now reconsidering. There's a lot of good reasons to continue to move forward, but people just aren't used to 5% interest rates, which brings us to today's interest rate, which is 5.25%. And that is the highest since 2009. As you all remember, 2006, 7, 8, 9, the mortgage meltdown, what was happening at that time. And yeah, it has been quite a dramatic rise, and I think we're going to continue to see it rise. We're seeing the 10-year rise. Let's just get right to the 10-year. The 10-year today is, is at 2.77. It had breached the 2.8%. We're probably going to see 3% by the end of the week. Now, that is unbelievable when you consider that 18 months ago we were at 0.43. That's right, less than a half a point or less than 50 basis points in terms of what the treasuries were yielding. Well, today or sometime this week, we're going to be at 3%. Really dramatic turnaround. Now, the 2-year, which was inverted last week, is now back down about a quarter point off of the 10-year. The 2-year is at 2.5%, and those two are acting in conjunction with one another between 0.3 of a base or 30 basis points and 25 basis points, or almost a quarter point to a half point, and that's really where they should be. The rest of the interest rates today, let's see, the 15 years at 4.42, the FHA is at 4.82, Jumbo is at 4.40, and the 5/1 ARM is at 4.08. Now, the ARM product, it's a great product, but in this type of market, you really got to be careful. If you're looking to buy and flip, if you're looking to buy and hold short term, if you're looking to get in and then get into a longer term 30-year fixed rate, this would be okay. But on the ARM product, we might see adjustable rates go much higher, especially in the volatility of what's happening. What we've seen in non-QM is astounding. We have seen rates now breach 6%, 6.5% on some, and you have to be and have stellar credit and a good amount down in order to get those products, which we have been touting as a way by which you can really compete with 30-year fixed. Well, right now, the rates are really priced out of the market. We had a number of loans in the pipeline at the company I work for be fooled around with. And what I mean by that is that they're delaying the approval process simply because rates have gone up. If you locked 30 days ago, the rate today on a non-QM could be a point higher. Now, anybody that's trying to fund the loan that they locked 30 days ago, well, good luck. You're going to see appraisal issues. You're going to see other issues, whether it's a continued rise in the number of conditions that you're going to have on that loan. They're not going to want to fund that because they got to, secondary has to sell that loan. So this is the kind of market we're in right now. So if you have an ability to fund quickly, that's the best way to go. If you have an ability to fund all cash and then refi, that's another good way to go. Okay, so the 10-year we covered. Net gains on mortgages. Just to give you an indication of where the mortgage industry is headed, as anybody who's paying attention will tell you, loan officers are getting fired. In-house processing and underwriting is also getting fired. We have a number of companies who are in the iBuying business, which means that they buy and then they fix up and sell that company, and they put all their people on salary. They're firing a lot of people. A lot of people in the industry don't understand how that particular model is going to work in a down market. We'll wait to see. So in 2020, the amount of money that you're making on a loan was about $4,200. In 2021, to 2,300. Now, 2,300 may seem like a lot if you're doing 1 million loans, but if you consider that 4,200 was a way by which companies were making good money, and the break even is really at around $1,000, so there's not a lot of room to play here. Basis points are 382 in 2021. They were 434 in 2020, and 2.5 employees per loan, whereas in 2.5 loans per employee. That's the way they figured it out in terms of cost. And in 2020, it was 3.3. Pretty interesting, all of that, and how it breaks down the numbers. And you can go to Housing Wire if you want to catch all that. Anyway, sorry about the confusing. It's just that it's the volatility and the change in the market really makes it difficult to get a handle on it. As speaking today, right now, we've seen the 10-year actually fluctuate. So anyway, better tuned. See you next time.